think it's clear that we're deep into bubble territory. Bubbles are characterized typically at the end of a long bull market by a period where they accelerate and they start to rise at 2 or 3 times the average speed of the bull market. And of course, they're always extremely overpriced by average historical standards. And this one, there are a few people who would still argue that 2000 was higher, but most of the data suggests that this is the new American record for highest priced stocks in history. And then there's the most important thing of all, which is crazy behavior, the kind of meme stock, high participation by individuals, which has kind of tripled in 18 months to an abnormally high level, enormous trading volume in penny stocks, enormous trading volume in options, and huge margin levels, peak borrowing of all kinds. And the news is on the front page. The news is not on the financial page. The big market events are on the front page. This is all characteristic of the handful of great bubbles that we've had, which are 1929 in America, maybe 1972, certainly 2000, and in the housing market, certainly 2007-8. In Japan, 1989 was the biggest and the best of all the major markets, and even bigger and better in their real estate market. So we've checked off all the boxes. Now the question is, how high is high? Very hard to tell always where the peak will be. But what you do know is that how high the peak is has no bearing at all on what the fair value is. So let us assume that the fair value on the S&P is, let us say, 2,400. Whether it stops at 4,300 or 5,300 doesn't change that. What it does change is the amount of pain that you get to go back to fair value and below. The case in point would be Japan. Japan had never sold over 25 times earnings in 1987, 88, 1989, until it went through 25 and went all the way up, we were told at the time, to 65 times earnings. And the price you paid for that is that they're still not back to the same price they were in 1989. And their real estate market, which was even a bigger bubble than the stock market. In fact, I believe the biggest bubble in history, bigger than the South Sea bubble and the tulips. The land under the Emperor's Palace really was worth the entire state of California. And the price they paid was that their land is still not back to 1989 levels. So 32 years later, they're still down. And that's how you get a major drag on the economy. Because when you mark down housing and land, it's an even bigger and more dangerous business than the stock market. And if you do it at the same time as the stock market, then you have an enormous loss of perceived value. And that is a big, big drag on the economy, which the Japanese have had to absorb. And it took them perhaps 20 years. And we paid somewhat the same price in 2007 because we had the first really interesting housing bubble in American history. We had never had one before. And it was the kind that was so extreme, it would only occur every 100 years or so. And we worked out that if it went back down to trend, it would cost $7 trillion. And it did go back perfectly. It was a very well-behaved bubble. It went smoothly back at the same speed that it had gone up, 3 years up, 3 years down. And then for good measure, as is usually the case, it went below the old trend line value and added another couple of $1 trillion of pain by the housing market going even lower. And that housing market was so big and profound and so accompanied by financial instruments of the notorious subprime variety that it took the stock market down with it and caused, obviously, a financial crisis. 2000 is a very interesting contrast because 2000 was a much higher equity bubble than 2008. But the real estate market was cheap, actually very cheap. The REITs were selling cheaper than the value of their properties. And the properties themselves were cheaper than the cost of building them. And the yield on the REIT portfolio at the very top of the market was 9.1%. Secondly, bonds were cheap. Bonds were incredibly cheap. And the new inflation-protected bond, called a TIP, had just been introduced, and it yielded 4.3%. Just imagine that. 4.3% guaranteed protected against inflation, guaranteed good money by the government. And the regular bond market was very cheap. So bonds were cheap, real estate was very cheap, and only the stock market was expensive. And it broke beautifully, of course, relatively well behaved. The NASDAQ went down 82%. The S&P went down 50% from that 2000 tech bubble. But the recession was not that big a deal because housing was not involved and bonds were not involved. This is the only time in history where we have a bubble in the bond market everywhere in the world. We have the lowest rates in 4,000 years, according to Jim Grantham. And 25% of all government money, you actually pay the governments around the world to take your money. They don't pay you, you pay them. And there's no historical precedent. And that's typically slightly bigger market cap, the bond market, than the equity market. But then the equity market, we have probably the highest priced US equity market ever. And if not the highest, a very close rival to 2000. And then if that wasn't enough, we have coming up on the rails at incredible speed, the US housing market. It's up over 20% in 12 months. It's the biggest move in the history. It's bigger than '07, and it's taken the median house price to a higher multiple of family income than even 2007. And that's all over the world. The stock market is not that expensive around the world. It's really clearly a bubble in the US, but outside the US, it's merely overpriced. We typically identified a bubble zone. Often it went on quite a lot longer, but it always fell below the point where we had suggested it was entering bubble territory. So once it broke through the peak, the 1929 peak of 21 times earnings, we started to be bearish in 1997, but only a little bearish. And then as the PEs rose and rose from 21 times to eventually 35, we became more and more bearish until we were screaming bearish, and still the market went up for another year. So we were pretty early. In the housing bubble, we did much, much better. We basically walked people through the last year or 18 months, pointing out how dangerous the subprime and so on and the housing market and how much damage it would do. We pretty well got that one right. And of course, we got extremely lucky on reinvesting when terrified, which was posted the day the market hit the low in March of '09. And here we are. I thought we entered bubble territory about last June, about a year ago. And I've made it quite clear what I consider a definition of success. And that is only that sooner or later, you will have made money to have sidestepped the bubble phase. So I am suggesting that the last 20 or 30% of the market will be retraced with interest. And I would expect that the fair value of this market would require the market to approximately halve. And I would be surprised if it did much less than that. And if it goes up another 20%, it will have to get rid of that as well as a bonus. The bubbles tend to peak at absolute optimism when the economy looks perfect and you're extrapolating it forever. And that's the definition of a bubble. And they have to be facilitated by friendly monetary conditions. And when you've had a wonderful economy and friendly monetary conditions, you've pretty well always had a bubble. They're not that common. And here we are again. But we feel the economy looks wonderful. If we extrapolate it forever, it means it's worth a huge price. Of course, it never does last forever, but if it did, it would be worth a huge price. And that's the mechanics that is going on. And then you can say, what might rattle the cage? Well, I think unexpected COVID problems on a global basis and in the US might rattle the cage. Unexpected inflation that doesn't go away in a hurry and then starts to run into longer term inflationary pressures, which we could discuss, that might rattle the cage. And the biggest cage rattler of all is everything else you haven't thought about that could go wrong. And my guess is that's probably the cause in the end of most of the bubbles deflating. The mechanics of a bubble is you have maximum borrowing, maximum enthusiasm. And then the following day, you're still enthusiastic, but not quite as enthusiastic as yesterday. A week later, you're not quite as enthusiastic as last week and last month. And gradually, the enthusiasm level drops off a bit. You have no more money to borrow. You're fully borrowed. And the buying pressure gradually slows down. And that's it. And there is a very interesting warning signal that has only happened a few times. And that is, in a bull market, the risky stocks go up a lot more than the blue chips. In 1928, the junky low-priced index went up over 80%, and the S&P went up, let's say, about 40. That's what you expect. In 2000 March, they start to take out the internet stocks, the pet.coms, and they shoot them, and they drop like stones. A month or two later, they're shooting the junior growth, and then a month or two later, the middle growth, and finally, by mid to late summer, they're really shooting even the Ciscos, which were giant companies. And they took the whole 30% of the market, which was TMT, they called it, tech, media, telecom. And it was down 50% by September. It had been murdered, but the S&P was unchanged, which meant that the other 70%, the Coca-Colas and the rest of the boys, the IBMs, were up about 17% on average to balance the books. So what had happened is that the confidence termites, I think of them, they had started at the most crazy pet.coms and worked their way down through the Ciscos, which were pretty outrageously, 80 times earnings. And then finally, they arrived at the broad market, and the entire market rolled over and fell 50% in 2 years. So nothing like that happens again until now. These are the biggest bailouts as a fraction of GDP, not only in the history of our country, but in the history of any country. This is a far greater stimulus program, both from the Fed and the government, that we have ever seen, with money supply spiking at 25% increase, with the government buying 40 billion a month of mortgages, even when the real estate market is up over 20% in a year to the highest level ever recorded. These are fairly crazy or reckless or unusual features, and we didn't anticipate either. And they're going to tend to send the market higher and longer. But as I said before, it doesn't change the fair value, it doesn't change the eventual outcome. Powell belongs to the Greenspan, Bernanke, Yellen little cult. They all fit together. They all realized that lower rates and moral hazard pushed up the price of assets. They all realized that assets going up generates a positive income effect. It simply does. You spend a couple of percent of what you unexpectedly gained. You count on gaining a bit, but if you gain 5 bits, then you spend a little bit of the extra the following year. So it has a very positive income effect. The same happens with housing. If housing goes roaring up, you remortgage, you make a trip to Spain, you put your kid through school, you do all those good things. And on the downside, you do completely the reverse. Anyway, so Greenspan and the boys and the girl took considerable satisfaction in the positive effect they had on pushing up asset prices. Lower rates and moral hazard will raise the price of assets, which they did all over the world. And no one was a bigger friend of the stock market than Greenspan. And he did race to the rescue when it finally lost air. And the S&P went down 50% from a very high level, but it only hit long-term trend. This was the first bust in history that didn't go crashing below trend and stay there for 10 or 15 years. So he did have an effect. What he wasn't able to do is he didn't stop the NASDAQ from dropping 82%. And if you're interested in Amazon, it dropped 92%. It had been the star of 2000, still dropped 92% before making everybody rich. But who, I wonder, held under the psychological damage of 92% decline? And the S&P went down 50%. And then you fast forward to Bernanke. Bernanke completely didn't see the housing bubble and the risk it posed. He said the US housing market merely reflects the strong US economy. The US housing market has never declined. It never had declined because it had never had a bubble before. Every time there's been a bubble, it has always declined. And Hyman Minsky lives. You create a situation like that, it will eventually blow up of its own weight, burst of its own weight. Anyway, he was convinced it wouldn't collapse. And of course, it did. And the housing market went all the way back to trend and below, which was a dreadful hit. And it created so much chaos. It carried the stock market down with it. Again, 50% on the S&P, almost exactly, for the first decimal point. These are not small declines, and yet they occurred in the face of passionate defenders and promoters of moral hazard, and I'll come to your rescue, and we'll make money cheap as it takes. And that took us through Yellen and then into Powell. Same story. They all talk a wonderful game about they'll be the friend of the asset class pricing, the friend of the stock market. And yet it didn't stop two of the greatest wipeouts in American history. The most impressive thing here is not that they do the same thing over and over again as if they have somehow no memory. It's the faith the financial community has in them, despite the fact that they have been let down badly twice. These were not insignificant setbacks. The tech crash was brutal. Amazon down 92. Every growth tech stock was down 70 or so, it seemed. The housing bust was merciless. The stock market decline of 2007 was really painful. And yet it's as if it never happened. Oh, Powell says this, Powell says that. The Fed has money. The Fed is going to be our friend. Hey, Greenspan was our friend. Bernanke was our friend. And we got croaked, guys. What is the matter with you? Why do you think the Federal Reserve simply does not understand the risks of asset price bubbles and asset price collapses?